Welcome everyone. Strategic sourcing and procurement management is the topic for this presentation. We'll talk about strategic sourcing. We'll come with some kind of calculation. We'll have a brief review about it and like to give you certain ideas to the audiences as to what kind of sourcing and procurement management should be taking place. So agenda is just very simple. We'll need to understand why there's a rise of global sourcing. What is the important financial and operational performance indicators impact that supply management activities have applied? Identify and describe the various steps that is involved out there for your business. Describe the major steps of the procedures to pay cycle. Discuss some of the longer term trends in supply management and why are they so important. Why supply management is critical. This is one thing that we need to understand. Remember, global sourcing means the firms do not compete against only the global competitors, but against their competitors' supply chain also. So everyone they are going to compete with. It's not only the global competitors, but whoever is a vendor to them has also been competed against to keep up the global competition and tap into the abilities of world-class suppliers. Many companies have put up in place a global sourcing system as to select raw materials, select people, select anything that is termed as a resources at the cheapest, at the best quality prices wherever wherever it is available. Advances in AIS or information systems have served as a catalyst for global sourcing effort. Global sourcing applies to services, business process, as well as manufacturing goods. Now, allow me to give you certain data for you to understand. See, financial impacts way back in 1997, and I'm talking about approximately 25 years back, and probably around 11 years back. So you look what is the change that has come across from the cost of materials. It has within the span of 14 odd years. Or 14 or 15 odd years, if you want to say around it, the food cost has come down from anywhere somewhere down 53% to 63% and hike of 10%. The chemical cost, there was again a similar hike of 6%. Plastic and rubber, there was a similar hike of 6%. And on an average, if you look into it, you will see there is something called 7% of a hike. So why this thing is critical? Supply chain is critical because if we are not looking at the cost of material, or let's say the value of shipment is moving around. The global supply chain is very much active, very much pertinent. So financial impact is the cost of the goods sold, the purchase cost of the goods from the outside suppliers. Merchandise inventory is a balance sheet item that shows the amount a company paid for the inventory and it has on hand on a particular point in time. The profit margin is the ratio of earnings to sales for a given time period. Return on assets is a measure of financial performances generally defined as earnings and total assets thereof. This is what we are looking forward to. Yes, COGS or cost of goods sold, merchandise inventory, profit margin, and ROA, return on assets. Let us understand with the financial impact. If we look into it, approximately for a target corporation, let's say the sales is around $65,000. The COGS, the cost of goods sold, is around $45,000. So there is a pre-tax earning on approximately $4,600. You see what has happened with the selected item, merchandise inventory. We have 7,500 as a merchandise inventory, and the total asset is $17,000 approximately. So profit margin is 100 times the earnings per sales. Profit margin is 100% into multiplied by $4,600 divided by $65,000, approximately 7% around it. That is what we are looking into it. Whereas a return on asset is 100% of earning by assets. If we look into it, 100% by $4,600 divided by 17,000, roughly 27% on an average. So look at assets, look at merchandise inventory, look what are we earning, pre-tax earning, and so on and so forth. So this is all the example of a target corporation. So financial impact, every dollar saved in purchasing lowers COGS or cost of goods sold by $1, increases pre-taxes profit by $1 itself. So profit leverage effect happens, a term often used to describe that $1 in cost saving increases the pre-tax profit by $1, and an increase in $1 in sale increases the pre-tax profit by $1 multiplied by the pre-tax profit margin. So this is what is the importance of what savings can actually reflect on your balance sheet. So every dollar saved in purchasing dollar lowers the merchandise inventory figures, and as a result total asset by $1. So let's say if we are targeting as a target corporation, if they are targeting only 3%, it's a very much a manageable purchasing reduction on a COGS or cost of goods sold. So sales is around $65,000. Cost of goods are around $45,000, reflecting savings absolutely on the same things. Pre-tax earnings are around $4,600. Now, if you look out here, if there's just 3% saving, you see your pre-tax earnings wobbles by 30%, almost 30%. That becomes a $6,000 from $4,500 to $6,000. So selected balance sheet, what does it happen from $7,500? It becomes $7,300. Merchandise inventories goes down. The total assets also goes down over a period of time. And what are we doing it? We are doing nothing, but probably the cost of goods sold is what we are looking at and reducing at the sourcing part. So performance impact, cost is not the only criteria, definitely not. Purchase goods and services can have a major impact or effect on the performance dimensions, including the quality and delivery performances thereby. Now, strategic sourcing. Let us understand how do we go with strategic sourcing. There are basically six steps to go around it. Number one is to identify the opportunities, ways to build up long-term businesses by probably having a better understanding of the sourcing needs. So identify opportunities, the spend analysis, then probably profile your internal and external things, category profile, industry profile, develop the sourcing strategy. Now this is where you have to look at a long term business performances, long term relationship with your vendors, long term sourcing strategies, selecting the suppliers, screen them, create a selection criteria, the RFI, the request for the inventory that needs to be goes given around. Supplier long list has to be provided. Conduct the supplier selection in terms of multi-criteria model and shortlist the supplier. Now, what kind of model might be? It might be the credit that they are giving. It might be the quality of goods they are giving. It might be the prompt services and supply they are negotiating. So try to find out what works best for you and then probably implement the idea, negotiate and implement the idea is from the request for proposal to request for quality. It can be negotiation and contracts thereof. So step one, let us decide all those six steps. Explain the six steps is spend analysis, the application of the quantitative techniques to purchase data in an effort to understand better spending patterns, identify opportunities for improvement, for saving costs. So, what categories of products, what categories of services make up a bulk of a company spending? How much are we spending on various suppliers? What are the spending patterns like? Let's say, probably in a different location. Step two is profile them absolutely internally and externally. What are you looking at it and what is the reputation outside? Two approaches to creating profile, category profile, understanding every aspect of the particular sourcing category that could ultimately have an impact on the sourcing strategy. Next is industry analysis, profile of the major forces, major trends that are impacting the industry, including pricing, competition, regulatory forces, substitution, technology changes, supply, demand trends. We talk about developing a sourcing strategy, the make or buy decision, a high level, often strategic decision regarding what products or what services to be provided internally and which can be provided externally to the supply chain. We are talking about insourcing. Insourcing is the uses of resources within the firm to provide the production services, or outsourcing, using of the supply chain partners, your vendors, to provide the said product or services. So advantages and disadvantages, both of insourcing and outsourcing. Remember, insourcing is within the organization, outsourcing is outside the organization. For insourcing, advantage is high degree of control, definitely yes. Ability to oversee the entire process, obviously yes. Economies of scale, the more you produce, the lesser the cost. average cost goes down. But then the disadvantages is reduced flexibility, strategic flexibility, if I may say so. You are completely tied down. You are not able to deploy your resources elsewhere. Requirement is heavy investment, absolutely high investment. Potential suppliers may offer superior products at a lesser cost, and that might be detrimental to you. So, what makes it the outsourcing much more attractive? Let's say high strategic flexibility, definitely yes, you can deploy resources here, there, thither, as and when required. Low investment risk because the vendor is going to pick up the tabs. Improved cash flows, access to the state of art products and services. Now, let us talk about the disadvantages thereby. We are talking about possibilities of choosing bad suppliers, loss of control over process and code technologies, communication, coordination challenges, increased risk of supply chain disruption, corporate social responsibility, or CSR as the case might be. Let us look into the factors that affect decision to insource or outsource. Environmental uncertainty might be favoring insourcing because there is no uncertainty at all, but it might not favor outsourcing because environmental outsourcing might be very high. Competition in the supply markets favors insourcing. Yes, it's probably very low. Sorry, it's very low for environmental things. The other way around. And if you look into it, there are only one thing that favors insourcing. That is the relationship to product services in buying core competencies. Whereas this is completely opposite in terms of outsourcing, which is completely at the hand of the vendor. So you cannot have a good relationships. Now, what else can be in favor of outsourcing? It can be environmental uncertainty. If you can give the job to two, three, four different vendors, probably there are chances that some of the vendors are going to fulfill your request. So probably you can divert or probably sway away in the uncertainty period. Similarly for competition, similarly for ability to monitor suppliers' performances as and when on basis. So it favors outsourcing, much becomes much more feasible. Step number three is developing a sourcing strategy. The total cost analysis, a process by which firms seeks to identify, quantify all major costs associated with various sourcing operations. Now we are talking about the direct cost and the indirect cost. The direct cost are costs tied to the level of operations or supply chain activities thereby. Indirect costs are costs that are not definitely not tied directly to the level of operation or supply chain activity per se. So you have something which is directly linked to it as for the operations and supply chain activities, and there are certain things which are indirectly linked. Costs that are indirectly linked, let's say reputation, let's say the quality, the level of operation and supply things. Now, the strategic process, sourcing processes, how do we go around it? In terms of insourcing, we have direct material, direct labor, direct feed cost, direct overheads. But in outsourcing, we don't just have the prices from the invoices, nothing else, and probably at best your freight cost, the transportation cost. The indirect cost in terms of insourcing would be supervisions, administrative supplies. You need to man people out there, right? You need to maintain such department as in maintenance, equipment depreciation, utilities, building lease, the rental part of it, the fixed overhead. Whereas in outsourcing, nothing. If the indirect cost is all about purchasing, all about receiving, all about quality control, might be an issue. That's the only thing that comes around it. So let us develop a sourcing strategy in terms of portfolio analysis, a structured approach used by decision makers to develop a sourcing strategy for a product or a service based on the value potential and the relative complexity of the risk represented by the sourcing opportunities as the case might be. Now there are four kind of quadrant that comes around it. Remember, that is what we need to go around it. The routine quadrant is availability of the regular products, regular services. Absolutely, it is almost a minuscule part of the firm purchasing expenditure. Whereas the leverage quadrant is standardized, readily available product, but represent a significant portion of spend. So the amount of money is on a higher end, higher side. And then there's a bottleneck quadrant, product and services which are unique, probably even complex. Probably they are only one or few suppliers. Absolutely. So you are dependent on them to supply it to you. And the critical quadrant is the product or services with unique, complex requirement and perhaps has only very limited supply base. So that is what needs to be taken. So routine quadrant, we talk about leverage quadrant, bottleneck quadrant, and the critical quadrant per se. Now, how do we go with sourcing around it? We can have multiple sourcing, we can have single sourcing, we can have cross sourcing, or even we can have a dual sourcing. Which sourcing is better? Allow me to elaborate further. Let's say single sourcing, the buying firm depends on a single company. Now, look what happens. You are putting all your eggs in one basket. If something goes wrong with the sourcing company, probably your operation gets disrupted. Then should we go for multiple sourcing? The buying behavior shares his business across multiple suppliers. Definitely yes, probably. But then what happens? You have to manage a lot of invoices. You have to manage a lot of inequality in terms of quality is concerned. Then can we have go for cross sourcing? The buying firm uses a single supplier for one particular part, another supplier with the same capabilities for different part of the services. So you are fragmenting your product into subparts and probably making ensuring that only one particular kind of suppliers are going to do one particular kind of inventories or raw materials or finishing products or work in progress products altogether. The other suppliers are going to do a complementary part, a different part altogether. So that will be cross sourcing. Dual sourcing is a buying firm using two suppliers for the same purchase, products or services, having an alternative, creating an alternative supplier. So you need to tell me as to what is the right decision. Let us move to step number 4. It's all about screening suppliers, probably creating the selection criteria thereby. The qualitative criteria to evaluate supplier include process, design capabilities, management capabilities, financial capabilities, conditions, cost structures, and things like that, and the long-term potential thereby. So conduct supplier selection. Now, what are we looking into it? Weightage point evaluation system. Assign weight to the performance dimension. Rate the performance of each suppliers with regard to each dimensions. Calculate the total score. How to go about it. What to do around here. We are talking about step number 5, conduct the supplier selection. Now, this is where you need to apply a logical conclusion, or if in case there is a problem with it, go mathematically, as in weighted point evaluation system, wherein you are going to give your performances are duly weighted. Well, let's say X denotes the supplier X, Y denotes the performance dimension Y. So performance of XY would be rated performance of supplier X with regard to the performance dimension of Y, and give the weighted assigned weightage to a performance dimension. And this will give it to you whether it is performing the right score as or not. Remember, summation of all weightage criteria should add up to a perfect one. So you might have those weightages. Let's say on time delivery, the weightage is 20%. On credit payment would be approximately 30%. Quality of the product is next 50%. So 50 plus 20 plus 30 is 100%, or point 0.2, point 0.3 plus zero point 0.5 is added to 1. Now based upon it, now you need to give a weightage around it, and you will able to come to decide which is a good competitors or which is a good supplier. Let's say the last step is the negotiations and the implemented agreement. This is where we are looking at competitive bid, a request for bids from suppliers from whom the buyers is willing to do business, request for quotation, formal request for suppliers to prepare bids based on terms of conditions set by a buyer, description of the market grade, industry standard, description by brand, description by specification, and obviously yes, the performance characteristics. Now, did I negotiate arguments? Did I give weightage to certain things as in market grade, brand, specification, performance criteria? You need to negotiate them. You need to understand which is in favor of you, what suits your operations the most. A more costly interactive approach to a final supplier selection. This is used when the item is new or technically complex items with only vague specification. The purchase requires agreement about a wide range of performance factors. The buyer requires suppliers to participate in a development efforts. The supplier cannot determine risk cost without additional inputs from the buyer thereby. Let us move to the step number 6, as in contracting, the process of creating a detailed purchase contract to formalize the behavior, the relationship, the formal uh, mode of conduct between the supplier and the buyer. So it can be a fixed price contract, as in stated price does not change for a foreseeable future. Cost based contract, which might be says the price of the goods and the services tied to the cost of certain key inputs and probably the economic factor thereby. So let us need to the move to the procedure to pay cycle. order, the document that authorizes a supplier to deliver a product or a services and often include key terms of conditions such as price, delivery, and quality requirement. Follow of expediting is in the receipt and the inspection, statement of work, scope of work, terms and conditions for a purchase service that indicates, among other things, what services will be performed, how the service providers are going to be evaluated. Let us talk about settlement and payment. Maybe paid through electric fund transfer or EFT. Maybe it's through a record maintenance. Now, whatever we are going to go, we need to keep a footstep or track of what exactly is happening around it. This is most important. So yes, we are talking about ordering, follow up, expediting, receipt and inspection, settlement and payment, and record maintenance is thereby. Now, let us concentrate on the trends of the supply management instead of sustainable supply. What are we looking into it? Becoming a more conscious of importance of being environmental friendly and using environmental performance in selecting supplier, ensuring compliance with regulations, reducing packaging, promoting recycling, and reducing cost while being goods for the environment as on when on basis. If we can go about it, nevertheless, or else we need to move around. So yes, we are talking about more conscious and important with respect to environment, with respect to ecology, with respect to the laws of the land and the regulatory framework, and reducing packaging, probably promoting recycling, reusing, and reducing cost thereby. So the last thing would be the disruptions on the supply chain, which might be because of natural disaster. Let's say there's a storm, there's an earthquake, there's a tsunami, economic or political event. Probably there's an invasion in the country, there's a war that's coming around it, there's an election procedure that goes around it, causes of a big threat to the revenue sources. Yes, leads to increased risk due to the outsourcing to global competitors. Absolutely yes, because then whatever affects in a different part of our corners of the world affects you all the way. With this, I come to an end of today's presentation. Thank you for watching this video till the very end.